Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, we'll delve into the Tile Shop as they came out with earnings this past week. We'll also talk about Sonic's last earnings and a nod to the former Food Focus. Leighton will look ahead to Skechers in the final part of the show, and we'll talk about Walmart once again as they again make our show rundown this week, this time with a new auto parts partnership that they forged and announced this past week. This episode brought to you by AdRoll.com, which helps ambitious brands orchestrate social ads, email, and other marketing channels to drum up more revenue. And as we so often remind you to do, please rate us on whichever platform you access us week to week. We appreciate your time and whatever feedback you can give. We lead today with the story that actually led last week's show. We're talking about Sears Holdings here, and they did announce and make things finalized in terms of their bankruptcy earlier this week. But in light of their announcement here, retail REITs revealed that they were planning for Sears' closing all along and potential liquidation here. This is interesting because not all retail real estate investment firms actually made press releases this week, but Kimco and CBL let investors know that they knew this day essentially was coming for Sears Holdings, and they did not hold back in terms of planning accordingly or putting out these press releases that kind of gave us a glimpse into their thought processes over the last 5 years as Sears Holdings was struggling so mightily. Unlike with the Toys R Us bankruptcy, which was a bit less anticipated as far as total liquidation, the sheer length of time Sears' descent took allowed some REITs like Kimco, like CBL, to apparently take advantage of the situation.
I love that we're talking about real estate yet again on the podcast. It's something that I love, but something that really relates to what we've been talking about recently with Sears Holdings and a lot of the other retailers that are filing for bankruptcy and closing stores throughout the nation, because you have to think about the commercial real estate interests, the landlords that own the properties. What are they going to do in the future to create value? Especially in this case, you're talking about shopping centers that require a lot of redevelopment. You look at the sheer amount of square footage that Sears takes up in a lot of their spaces. It's astounding. But first, we'll dive into Kimco here. They were more bullish than a lot of the other retail REITs, going as far as to say Sears Holdings' announcement could create significant value creation opportunities. The idea here is that Sears was paying below market average rents to Kimco in the past, and having Sears vacate Kimco's property may actually allow them to increase the amount they are getting paid per square foot. Kimco sent out a press release shortly after Sears Holdings' announcement on Monday, meaning that they likely had this in the works well in advance. Management was prepared to go and address the situation. It seems as though both Kimco and CBL were seeking to limit investor fear about what the bankruptcy would mean for their portfolios, and both actually spun it in a positive direction, something we were really interested to see because, again, you talk about retail bankruptcies, a lot of big name retailers closing their doors. You think a lot of negativity could surround the management ranks in these REITs, but not for Kimco. And Kimco, as far as they were concerned, they just have 14 Sears Holdings leases in their portfolio. 3 Sears, 11 Kmart's. One of the Kmart's, however, is actually subleased to At Home, the up-and-coming home goods retailer, meaning that the lease may not actually be overtly affected by the bankruptcy. We see this amounts to just 0.6 of their annualized base rent. So you look at their entire portfolio, 0.6 of the rent coming in is from Sears Holdings. That's not a big percentage. However, 1.9%, almost 3 times that number, is actually represented via the company's total gross leasable area. So the amount of square footage that they have outstanding is actually proportionally higher, meaning that, as the numbers suggest, Sears isn't paying even close to the average lease rates for the properties overseen by Kimco. In fact, these 14 leases average just $5.25 per square foot, where Kimco's portfolio averages $15.95 per square foot, roughly 3 times higher than what Sears is currently paying for those locations. You can make the argument that some of the Sears or Kmart stores aren't in as desirable retail areas as the rest of Kimco's portfolio. Kimco does own some Class B and Class A properties throughout the nation, but Kimco still feels as though there is potential for redevelopment for these properties. On that note, Kimco is careful to mention a relatively high population within a 3-mile radius of these 14 separate leases and average household incomes of $88,000 in these areas. However, these numbers are skewed by top-heavy properties in their portfolio. Of note is the Bridgehampton Commons in New York, where they have the average household income of $193,000, and Kendall Lakes Plaza in Miami, which actually has a population of 215,000 people within a 3-mile radius. Already to this point, Kimco has gone about reducing exposure to Sears properties or redeveloping older locations. In this release, Trent, they make specific mention of dramatic turnarounds in a few major metropolitan areas, including Los Angeles, my favorite, Staten Island, Orlando, and Baltimore.
Specifically here, they mention being able to replace Kmart at a rent spread of a whopping 727% in Staten Island, meaning, of course, that they're making 727% more per square foot on overall rents by bulldozing the Kmart store and making way actually for an enormous shopping center with multiple tenants, including both off-price and regular retail stores. In Los Angeles, they went off-price with a Kmart. They turned a Kmart into a Ross and DD's Discounts. That churned out a 748% rent spread, kind of telling us exactly how little Kmart was paying per square foot in that location. And overall, Kimco's developed or redeveloped 8 buildings vacated by Sears Holdings, and they have an average rent spread of 211% at these locations after redevelopment. So when they say this is an opportunity for them, they have a little bit of a past here to back it up, simply because of what Leighton mentioned. The fact that Sears Holdings was paying on average $5.25 per square foot. In this retail climate, if you're in an A or B shopping center, you're going to be looking at usually about 3 times that. And so that's something that certainly Kimco has their eyes on, and ultimately we'd be suspect of a retail firm painting mass store closures in this case as an opportunity. But once again, Kimco has a track record to back it up, and they've been able to pare down their Sears Holdings properties to ones in ready-to-develop areas if they do need to reclaim them. Most of them seem to be readily available to reclaim. Now, when we talk about ready availability to reclaim, no real estate firm perhaps went as far as CBL. In the case of CBL, they haven't been so much as paring down their Sears Holdings properties in their portfolio as adding properties from Sears Holdings strategically. And we found this perhaps the more interesting of the 2 releases. While Kimco was the most bullish, CBL's really contained some valuable information as far as properties they've added from Sears Holdings, knowing full well that bankruptcy was on the horizon and anticipating potential redevelopment of those properties. And while this move may appear somewhat suspect to add stores into your portfolio from a retailer that may be failing, CBL has apparently been banking on this eventual bankruptcy to the point where they've been able to assemble plans for redevelopment and even signed leases on a few of them for a future date. This came from Stephen Leibovitz, CBL's CEO. He said, and I quote, "We have been preparing for an eventual Sears bankruptcy since 2013 when we purchased 2 Sears locations and transformed them into dining, retail, and entertainment destinations." Leibovitz in the release also noted that the current Sears stores in their portfolio are all well-positioned to bring in new retail or non-traditional tenants. They actually talked about hospitality and hotels being one potential tenant. They also mentioned housing and potential apartments and condominiums moving into some of these vacated locations as possibilities going forward. Now, the kicker here from CBL, once again, is not only that they've intentionally purchased locations with redevelopment in mind, but that they already have redevelopment plans in place for 3 of the locations on the closing list that came out this week from Sears. The closings list included Hamilton Place in Chattanooga, Jefferson Mall in Louisville, and Cross Creek Mall in Fayetteville. That's Fayetteville, North Carolina, by the way. All 3 of which, those are on the closings list. Again, those were actually just purchased by CBL in 2017. And ideally for CBL, pricing on these locations would have been somewhat lower considering the many concerns regarding Sears' liquidity at that time in 2017. But here's another key line from the release. And I quote once again, CBL has leases executed, out for signature, or under negotiation for a majority of the locations leased by Sears in its portfolio. So in other words, CBL was almost rooting for Sears to fail so as to redevelop these spots and jack up the amount they were pulling in per square foot. And overall, CBL anticipates owning 21 Sears stores operating in their portfolio by the end of 2018. That's down from 53 in 2015, some of which were sold off, but most of those have been redeveloped as well. And the fact that they have leases in hand or out for signature on 3 of the properties that they just bought last year that Sears announced that they were closing this week, it certainly suggests that CBL has been looking ahead to this day for a long time.
Generally, that fits CBL's MO over the past few years, and although their stock has seen better days, CBL has attempted to find outgoing anchors and replace them with higher margin solutions, usually with multiple retail/entertainment outlets in each. In conclusion, basically what we should keep in mind is that ultimately developers and real estate holdings firms, such as the REITs we were talking about in this story, are always thinking one step ahead. They're thinking worst case scenario. And with Sears, the writing has been on the wall. So it would have been on management if they would have been caught by surprise from this bankruptcy announcement on Monday. This is why we lend very little credence to the idea from certain retail CEOs that leases can be negotiated down or renegotiated altogether, as we've seen recently from the likes of Ascena Retail Group and Bed Bath & Beyond. In this current climate, there are plenty of retailers and entertainment companies lining up to take spots in A and B class shopping centers, leaving little room for negotiation with the actual landlords. And if a location is in a C-class area or worse, you really have to question whether it's worth it to stay even at a reduced rate, because traffic is going to be waning. It's not going to be as popular as those A and B class shopping areas. This is all just a reminder that the true winners in retail in a climate like this are ultimately going to be the property owners. There is still a finite amount of inventory in the United States, particularly good inventory, and you really have to weigh that against what the people are saying when you say you can renegotiate leases, because you really have to look at the leverage that some of these landlords have in terms of how many properties they have and how they're able to market the properties and create that demand. And all we need to see for evidence to this effect is the current lack of Toys R Us locations in the market, as many were snapped up immediately or at least in the process of redevelopment already. Relatively few actually remain on the market. People saw that coming. People took advantage. There wasn't really an opportunity for a lot of these buildings to just stay vacant for long periods of time. This may not be the case with Sears and Kmart, as a few remaining locations are in truly terrible retail areas, but many will be redeveloped and may even serve as a traffic driver for other retailers in a given area, whereas Sears and Kmart currently a tepid driver of traffic.
After months of strategizing and prepping budgets and looking at how we're going to position ourselves in the market, I didn't have anyone to fall back on. And I remember pulling the lever for all those campaigns, biting my nails, and just staring at the computer pretty much the entire day. This was the moment where, okay, we hired this guy to do exactly what he's saying. Now it's up to him to deliver. Trying to figure out the best way to serve ads to our customers, to me, it was a black box. AdRoll came in and said, we should target these users at this cadence, this frequency. We doubled our revenue based on what we were projecting for November, December. Succeeding after I've put myself on the line like that, it does give me confidence.
To find out how TeePublic and 37,000 other brands grow their businesses with AdRoll, visit adroll.com/retail. That's ADROLL.com/retail.
Well, on to our second story now, as the tile shop went on a roller coaster ride Thursday with a generally positive earnings report, but market negativity surrounding the earnings call due to the T word. The T word in this case was tariffs, and this sent analysts into a stir about whether the tile shop could continue their turnaround into future quarters. Now, taken on its own, if you didn't listen to the earnings call, if you just looked at the numbers and compared it to previous quarters, this quarter's earnings release was a powerful statement from the tile shop, who had experienced some dropping in same-store sales over the past 3 quarters. But this third quarter, the numbers showed that they are at least on track with their own expectations. Earnings per share hit 5 cents, meeting analyst guidance. Last year's third quarter saw earnings per share twice as high at 10 cents per share, a number that also bested outside estimates at the time, but a lot has happened in the quarters since. This latest quarter leaves them beating analyst marks now 2 of the last 4 quarters, and meeting guidance this quarter was in part a function of strong gross margins, which hit 70.6% as a result of them, and we've talked about this on the show in the past, trying to bring in higher margin items and bring in higher level products overall that they can command a premium for. So going back a few quarters for the tile shop, as I mentioned, their first few quarters of this fiscal year, pretty disappointing. The second quarter was a little bit better, certainly. Last year's fourth quarter was where it really fell off on a cliff, and the tile shop was left in a position where they needed to kind of redevelop, reinvigorate, and kind of start things up from within. This third quarter, some people are taking as a sign that the tile shop is turning things around. But once again, we'll get to the mention of tariffs kind of putting a little bit of a needle into that balloon. The tile shop posted revenues of $89.26 million for the quarter ending September 30th, 2018. This surpassed the Zacks consensus estimates by over 2% and compares to 2017 revenues of $84.42 million. So revenues overall for the tile shop went up, even if earnings did go down a little bit from a year ago. As we mentioned, it was a little bit of a rocky start to this fiscal year for the tile shop and a rocky end to the last fiscal year for TTS. The management of the tile shop in their official investor relations press release actually attributed this to product, merchandising, and service quality. A lot of it has to do, though, with some of their behind-the-scenes work, as I mentioned, to stock better product and command a premium for it. Same-store sales, as a result, grew 2.1%. This after a couple of quarters of declines. Over 2 years ago, we would not have predicted negative comps at all for the tile shop, but then again, not a lot of people would have. The fact that they're growing again after a bit of a speed bump is a good sign. And the 2.1% modest gain is in the face of what their competitors are doing, which admittedly is a little bit better than 2.1%. When you look at competitors, for example, like the Home Depot and what they're doing in the home improvement sector. But that being said, some speculate that better performing stores for the tile shop are going to carry momentum through the rest of the year. That better store presentation we mentioned and one-on-one customer service experience that they've sunk money back into is coming at a cost. Anytime you put money into one-on-one experience in the stores, that means higher staffing, store presentation. They've had to reinvigorate some of the stores and some of the layouts in the stores. That all costs money. And despite killing it on the gross margin front, they are seeing the higher costs of business pile up. Sales, general, and administrative expenses increased 13% in the quarter, up nearly $7 million. Store refreshes also cost them money. They've got a few more on the horizon too, and as a result, they've been taking out debt. And that debt is producing higher interest costs, which is also whittling away at their margins, despite the fact that they are carrying higher margin goods. So it's kind of a withering away of those margins that they're trying to develop. They've refreshed 10 stores year to date. They hope to refresh, as I mentioned, a few more in the future. And they've spent more doing this refreshing than they had previously anticipated, which could be looked at as either a good or a bad thing. But it's a bad thing if you're looking at the balance sheet, because once again, when that long-term debt is growing, that interest expense is also growing.
Sort of like trading one for the other, right? Because they have to refresh their model. They have to invest in their stores. They have to invest in staffing. They have to invest in all of the marketing surrounding a lot of their new product. And this is something we'll get into as far as the amount of SKUs that they have in store compared to last year. But this is a company that is going through a transitional phase. And one could look at Tile Shop, take a step back and say, well, the Tile Shop hasn't even been around that long. Why are we talking about these large strategic investments? And why are we talking about taking out debt in order to fund all of these when this company is still creating not much of a profit? However, management is thinking in the long-term view. They're thinking 5 to 10 years from now, not 1 to 2 months from now. So as far as the debt on their balance sheet, yes, long-term debt is growing, but the investments seem logical in order to be a standout retailer in the crowded flooring space. Carrying more inventory and sprucing up their store base is one way of saying that they're ready to service more customers and do so more frequently and accurately, be able to deliver to the customers in a quicker fashion because they have that inventory ready to go. And the inventory, as we'll get into, is a function of two things: hedging against tariffs and supporting their customer base. Interim CEO Bob Rucker said that they are almost done with their current assortment initiatives and are looking for continued traction after most deemed them to have a trying first quarter and second quarter with lagging sales and lagging profit. Their COO remarked on the earnings call that they have added roughly 2,000 SKUs since the fall of 2017, a massive addition when you consider that they now have 5,200 products to choose from in total. So think about that amount of product added over the last 4 quarters, a massive amount of undertaking, being able to negotiate the prices with your buying team and get all of that done. And here we are, 5,200 products. That is one way to differentiate, again, in this somewhat crowded market space. And you see more designer brands they're bringing into the fold. They want a varying demographic. They want people in the higher income brackets to start coming to the Tile Shop locations. Their pro business, however, you contrast the high one-time spenders with their pro business that are going to be spending more on a consistent basis. That seems to be going well. They have a lot of pro initiatives there at the Tile Shop. Something we've actually heard about a lot from other companies in this space like Lumber Liquidators and Home Depot and Lowe's. They're all bullish on supporting their contractors in any way possible. And this doesn't mean having more product in your stores to showcase to the contractors and having more price differentiation. This means servicing the pro business really well, asking them on a weekly basis almost, how are things? Is there anything we can do to keep your business? And so because of this dialogue that they've actually created with their contractor business, they've tweaked it a little bit. Now they have a pro loyalty program that was rolled out in June that they've already made some tweaks to. However, in the call, they really didn't go into much detail as to what they've been doing with this open dialogue, but they said that they are making strides with the communication aspect for their most frequent buyers. They want to know how they can service them better to ensure that long-term support. Again, it's all about communication. It's all about, are you happy doing business with us? How can we sustain that for the long term? Because that's going to help the bottom line. And again, if you take out the pro business, say all things equal, that's going to be a large percentage of the recurring revenue. And anybody loves a recurring revenue model out there, certainly in this type of space. But they continue to hold pro events at their stores, really getting that product recognition. Again, telling these contractors that, look, we're not going to be a business that you can just come to expect only a few thousand SKUs. They want to have an ever-evolving assortment for them to choose, and this helps them to better explain the benefits of being a pro loyalty member as well when they get people face to face and have that dialogue. But to better focus on sales and individual location performance, they are transitioning their management model, and this is something I wanted to pivot to and talk about for just a little bit, and that they now have more regional managers to oversee as few as 3 locations each. So if you contrast this with what the management team at the Tile Shop, the regional management team, has been doing over the past few years, they've been monitoring 12 to 15 stores each. And so that sounds like a normal number. Coming from retail backgrounds, Trent and I can both attest that we've had district managers that oversee a number of locations, sometimes over 24 locations. However, by having just 3 locations each to monitor, this will put more pressure on employees, on staff to meet certain monthly and quarterly marks. And obviously, this could certainly work to help motivate staff because you have that oversight. And perhaps the overhead would best be spent more on in-store personnel. This is the counter to the management argument, in that you're paying these regional managers probably 6 figures. And so perhaps you can divvy that up and just have more staffing to then boost sales that way. However, they do feel like having that additional oversight is going to be a little bit better. And their CFO, by the way, did mention on the call that they have reduced in-store staffing expenditures, after all, in lieu of more regional managers that will not be customer facing. So the regional managers are going to have more of a hands-on role in as far as training the store staffing. And I think this is going to be important because yes, hiring is very important for each individual store, but if they're not trained appropriately, they know less about the product. They know less about how to sell it. What key points are going to be standing out for the sales team versus one of their competitors? These are very important points that I think the management, the executive team, has really honed in on, and they feel that having regional managers more closely tied to locations will also help in the hiring process as well. They're going to be able to do their due diligence in getting the right employees on board, and if you think about it, that's going to, in turn, reduce turnover. So we talk about the expense of staffing. That's actually going to reduce it long term. So even if they have less sales staff per location, the idea is that they're going to be more competent and they're going to be spending less because they don't have to keep putting people through the hiring process. Regional managers, thus, after all of this explanation, will be looked at more as brand ambassadors. And Trent, I think this is probably a good thing for the company, at least, again, in their transition mode here, at least to try it out in the short to midterm.
For this regional manager, this new regional manager program, I think one of the keys for the tile shop will be that the store manager is really echoing the sentiments of the regional manager, that everyone is on the same page. Because, Leighton, you and I both know when the regional manager isn't echoing things that the store manager is echoing, when they come in to influence a store and you feel like you're getting two different messages, that in turn erodes employee confidence, and it also makes you awful weary sometimes. You don't want to go into work when the regional manager is going to be there. That could increase turnover, therefore. So this entire program, which as Leighton mentioned, is partially to decrease turnover, make sure that people are trained up so they can stay with the company and flourish with the company for long periods of time. That's only going to be possible as long as everyone is on the same page. But regardless of where their employer numbers are, the support is going to be crucial for the now 140 stores in their portfolio, this number being much higher than when we last talked about the tile shop. Store support in getting out their pro member messaging has cost them an SG&A, as we previously mentioned, but their CFO, again, 100% okay with absorbing the costs. Sometimes you see CFOs, no matter the size of the company, push back when they see a large proportional change in an expense class. But in this case, all of the senior leadership is on board with their strategic outline, which is absolutely critical for a transformation to succeed. And this leads us, in turn, to believe that more of those regional and store managers may also be on the same page going forward. Now, in terms of that T word, the tariffs, one thing that worries their CFO going ahead is something that has somewhat taken over the business news headlines, and it particularly took over the headlines with the tile shop this week, and that's tariffs. Tariffs are something that retailers will always come in contact with if major policy changes happen, but they're not always the first line of businesses to see direct impact. Usually the suppliers and vendors of retailers are the ones that have to negotiate the changes, and then it trickles down the supply chain from there. For the tile shop, they disclosed that they do directly source roughly 50% of their products from Asia, most probably in this circumstance from China. They have bought up inventory now in the interim in order to prepare, which serves as a dual benefit: better customer response times, lower cost of goods sold potentially, especially if they're getting volume discounts, and they're taking advantage of the fact that tariffs aren't yet amped up as much as they might be in the future. Chinese tariffs have affected some of their products such that there is a 10% tax now. If they go to that 25% number that's been talked about on January 1st, well, they are prepared to go elsewhere. By they, I mean the tile shop. They are prepared to go elsewhere, and buyers are currently looking into other countries. Now, what is troublesome is that if they can't offset the majority of the costs by either sourcing from different suppliers or being ahead of the curve, they may have to cut costs in some of those other areas that we just talked about them increasing costs in. While management didn't get into many details on the call as far as the future, what this would look like if they did, this would essentially mean that tariffs could have a direct impact on the plans to expand their business, hire those extra in-store personnel, and potentially refresh more locations in 2019. Their cost structure has really not been standardized or routine since the company went public, and granted, it's a relatively new or recent publicly traded company, as Leighton referenced, and tariff pressure would certainly throw a wrench into at least some of the company's plans to follow through with that 2018 vision that we've just kind of mapped out for you here on the podcast. And more importantly, it turned analysts into a spin. Some analysts believe that they will be able to overcome the eventual pressure on tariffs or work around it. Some people believe that the tariffs will absolutely murder their margins and they'll have to look to another source to kind of build from within and turn their store around.
One thing that some would note is that the potential for more expensive goods has actually been countered by the federal tax reform. So on one hand, you're saying that products could be heightened in terms of cost, so the cost of goods sold is going up because of the tariffs in China or other parts of Asia, but they just paid out $700,000 in the third quarter for their federal tax versus the $1.5 million they paid out in the third quarter, and their business fundamentally isn't that different. They're on the hook for a lot less money. This, in theory, can help to buy inventory now to hedge against future tariff increases. So, in our view, other capital expenditures shouldn't be put off because of tariff concern either. And so you'll hear a lot of investors talk about tariff concern as something they actually can't control. They can't control what our government is going to decide on. So business has to be the same day to day as it has been. Yes, you have to do what you can to hedge against those product increases, but interest rates are likely not going to be going down anytime soon. And thus, construction costs are actually going to be going up as well as inflation. You see inflation creeping up there. Even the labor market for construction workers is tightening. I say that to say this: keep on investing now while it's relatively cheap to invest in your business. Again, interest expense for the company is going up, but their interest rate is actually not that bad right now. So the time is now to invest in your company for the long term. Don't wait just because of the cost of your product is going up 10 or 25%. In that vein, they are not opening any new stores in 2018. They are, however, planning on opening 3 for 2019. This is something, in my opinion, they should say steadfast in. They should follow through with this plan because, again, you don't want to put off these things just because of short-term budgets. If you think that those 3 locations in 2019 are really good locations that are going to be sustainable for the long term, keep those plans in place. Not as many as we would like to see, even with those 3, and certainly indicative of a more conservative approach from the retailer. And I think that has a lot to do, Trent, with the amount of money that they've spent on some of those store refreshes. Modest sales growth and objectively small unit count growth have investors worried, though. This latest quarter showed progress versus the first quarter and second quarter overall. Shares were up initially on trading on Thursday of this week, but then down Friday to week lows. They ended at around $6.17 per share. Year to date, shares have been all over the place. A true roller coaster ride if you're a long-term shareholder, but substantially lower, and this is worrisome, than the 2016 and 2017 levels. And again, in terms of share price this year, highs around $10 in January, lows around $5 in March. The price to earnings ratio, however, is a pricey one, which, as we know, correlates to volatility more often than not. That price to earnings ratio for the tile shop is around 77 times.
Well, in the throwback to the old food-focused days, Sonic releases their final earnings call as a publicly traded company, for now at least. We all know that companies can be taken private and then sent back public again, but this brought a little metaphorical tear to our eye, as Sonic's one of the companies that we enjoyed covering on the Food Focus podcast. We talked about them frequently, particularly for their LTOs and once aggressive refranchising model. Sonic locations are now close to 95% franchised, and we'll talk about the sales breakdowns between franchise and corporate-owned stores here in a second. Many current owners for Sonic were able to take advantage of larger swaths of nearby regions, so when their refranchising efforts, you now have a number of franchise owners that own a lot of stores in that Sonic network. But last month, and this is the reason why it's their last earnings call as a publicly traded company for now, Inspire Brands announced its plans to buy Sonic for roughly $2.3 billion. They, of course, will be taking on the debt from Sonic as well. Sonic has struggled somewhat in the recent past in terms of this debt. Inspire Brands, you may know them because they own Arby's and Buffalo Wild Wings. They recently bought Buffalo Wild Wings after a long proxy battle and kind of a mess there at Buffalo Wild Wings. That was purchased back in February amid sales growth concerns. But really, Inspire Brands is well known for a turnaround story at Arby's. Arby's has been one of the highest surging QSRs in the United States. In fact, they have 4,700 stores between Arby's, Buffalo Wild Wings, and Rusty Taco locations worldwide. Rusty Taco, by the way, that's a subsidiary of Buffalo Wild Wings that Inspire ended up getting in the purchase. Now, in terms of return on this, shareholders, per the agreement, will get $43.50 per share. This is a 19% share price premium, and many saw this as fair, as traffic growth was pegged at around 2.5%, and growth in ticket was slated to bring in a slightly larger bump in total sales, but certainly nothing befitting perhaps a 19% pop in the share price. We go to Paul Brown, the CEO of Inspire Brands, back with this deal. He said originally that Sonic's differentiated model as a drive-in, very unique in the United States, is an ideal fit for the restaurant group because certainly differentiated from the other restaurants that they have. And you look at the other things that they do between Arby's and Buffalo Wild Wings, those are differentiated models within the marketplace. Sonic does have some great locations throughout the U.S., but they do have a higher than average rural or small town presence, very much akin to Dairy Queen or even the likes of Subway in terms of their rural presence. And if you go into a lot of small towns in the Midwest or the South, you're going to see Sonics there before you even see a McDonald's or Burger King or another QSR. Now, in total, Sonic has 3,596 locations in 45 states. They do have over $4.4 billion in sales, but we should remember that they franchise out all but 228 of those, so the bottom line might look a little bit thin, and their corporate income may look a little bit thin because really what you're talking about there are franchise royalties. What Inspire is buying is the royalty rights, essentially, since the company owns so few locations outright at this point, and even though Sonic has shown that they can profit seemingly forever, there is an inherent risk in having a more hands-off approach. The company does lease out 135 properties to franchisees and sublease 53 other properties. Overall, though, in terms of the franchise model, something we often talked about on the Food Focus podcast is even though it's a little bit more hands-off, oftentimes when you put the company into the hands of franchisees, they may take better care of their stores as long as you can push a proper direction out to them, simply because they have skin in the game. Their necks are on the line just as the corporate necks are on the line. And as such, sometimes you see that split between franchise-owned stores and company-owned stores and how the two are doing financially.
I really couldn't say it any better, Trent, because it is all about the resources that the franchisees are getting. And, you know, Sonic, for their part, it's not one of those franchises that you hear a lot of negativity surrounding what the franchisees are saying. So quarter to quarter, they seem to have the resources in place. And I think a lot of the franchisees were actually thrilled to have more stores in their portfolio when Sonic was aggressively refranchising 2, 3, 4 years ago. So they have a lot more locations in their portfolio. Thusly, the franchisees are getting taken care of because it is a very profitable business. You hear a lot about reinvestment, and this is something that Sonic has also been doing. And franchisees aren't pushing back. You hear a lot about pushing back from the privately owned Subway, those Subway locations. A lot of franchisees were saying that it was growing too fast such that it cannibalized the market, and then the parent operator, the parent company at Subway was wanting them to refresh their stores too often. It was too capital intensive for them. You don't hear that with Sonic. So a really good operator here, an operator that is focused on the mid to long term. Consolidation in the QSR and FSR space is strong. And with Sonic, this was a company a couple of years ago that we talked off air about, and thinking that maybe this is a company that could come under the umbrella of another publicly traded company or taken private. And here in the recent past, in the recent 1 or 2 years, you see a lot of companies. Panera Bread is one, or Panera, Popeye's Chicken, and Qdoba all being acquired by either private equity or publicly traded players like Restaurant Brands International. Companies with a lot of capital, a lot of money to be spent. And honestly, this is a company in Sonic that doesn't really have a lot of growth potential, but to Trent's earlier point, seems to be churning out just enough cash to really entice the leaders over there at Inspire Brands. As for their fourth quarter earnings, again, their last earnings report, unless something goes bad in this process, The closing of this deal, by the way, should be had by the end of the year. So this will be the final earnings call. With this earnings call, there weren't a lot of details, but it seems as though what we got at least was a lot of positive numbers that likely pleased the future owners at Inspire. Net income for the entire fiscal year hit $71.2 million. Again, it being the fourth quarter, you have the end of year results here, the fiscal year's end. For the fourth quarter ended August 31st, Sonic's net income was down 10.7% to $18.6 million. However, it's because, in large part, due to that refranchising. It's not as though the company is less operationally efficient. Quarterly earnings per share came in 2% higher than Wall Street guidance, which really proves out their operational efficiency, with 52 cents per share, 7 cents per share higher than they came in with last year. The last 4 quarters, by the way, have all resulted in earnings beats for the company. So 4 out of 4 for this latest fiscal year. The revenue, again, consisting primarily of those royalty payments that Trent talked about, came in a tad soft at $111.75 million. Last year did see higher revenue to the tune of about $12 million. This missed analyst estimates this year by around 1.33%. Same restaurant sales did go up 2.6% and were relatively consistent for franchise stores at 2.6% and company-owned stores slightly lower at 2.5%. Still, a very strong growth sign for the company, a good sign moving forward, as this is a metric they've struggled with in the past.
To that point, their same restaurant sales for the fiscal year, you mentioned them struggling in the recent past. For the year, their same restaurant sales declined 0.3%. They went down 0.3% at franchisees and 0.8% at corporate stores, kind of alluding to what I was talking about earlier in this story with their corporate stores kind of struggling versus their franchisee-owned stores. And realistically, the fourth quarter saved them from having a truly difficult year when it comes to same restaurant sales. Although when we look around at QSRs, at full-service restaurants, at fast casual restaurants, there are some chains that are out there that are struggling. We're not seeing that growth in same restaurant sales as we are in same store sales in the retail realm. If a company were to end a year down 0.3% in same store sales in the retail realm, we would say that's a pretty difficult year in the light of such a substantial retail market currently and what we've seen in the last 12 months. But on the restaurant side, the story is a little bit different, and so 0.3% is actually not good, but not terrible either, especially when you're looking at Aspire Brands taking this over. They had to like what they saw in the most recent quarter. Now, margins did decline 80 basis points over the prior year's fourth quarter. And as far as growth in stores, they did add 23 new stores in the fourth quarter alone, which is a bit of a growth spurt from the prior 3 quarters, to be sure. We discussed on Food Focus about how Sonic's past growth plans had recently stalled because of flagging results and also some cannibalization of already existing Sonic locations. For the year, they saw 41 new stores be put into the system. So 56% of those openings came in the final 3 months of the fiscal year. So Inspire Brands is in position, if everything goes through and everything goes smoothly for them, to pick up a brand that appears as though it's on a bit of a bounce back. Now, what we don't know yet is whether this fourth quarter is a little blip upwards on the radar of a slowly declining brand in Sonic, or whether Inspire Brands can pick up the momentum from the fourth quarter. But the sad thing is we won't really know going forward because, again, they're being taken private. So we won't hear probably as much from them, just like we haven't heard as much from Buffalo Wild Wings, but still a story that we'll be looking ahead to and keeping an eye on as Inspire Brands takes over their portfolio. Well, our final story on the Retail Focus podcast comes via Walmart. They make our show once again, this time because of a newly minted partnership with Advance Auto Parts and some unique money-saving initiatives. This Advance deal, could be a major win for Advance Auto Parts because they've been slipping in market share over the last 2 years versus their bigger competitors in AutoZone and O'Reilly's. We often refer to these 3 companies as kind of the big 3 in auto parts retail, and Advance is certainly right now the consensus number 3 auto parts retailer within the U.S. We've seen positive same-store sales on the whole at AutoZone and O'Reilly's. Certainly, they've had down quarters over the last couple of years, as Advance has, but Advance hasn't seen that overall growth that AutoZone and O'Reilly's has. lately. When we talk about this story overall, this kind of piggybacks on last week's episode when we noted that Walmart is as open to partnerships as they are acquiring companies outright. They get a lot of press for acquiring companies like Bonobos, for example, or Jet.com outright. But they're also very open to partnerships, Leighton. And overall, Walmart, for their part, does have a pretty significant role in the car maintenance world.
They absolutely do. And if you go into a Walmart, any typical Walmart supercenter, they do have a lot of Salesforce space dedicated to basic car maintenance related sales or related items. So overall, this is kind of a head scratcher because if you think about it, Advance Auto Parts is more or less a competitor or indirect competitor to Walmart. And while they have more of a product selection, Walmart really has been dwindling down their product assortment in this particular category over the last decade or so. It's just one of those things that tends to be out of favor with Walmart as they look to increase their grocery selection, as they look towards more seasonal advances, and in terms of toy selection, as we've noted over the past 12 months or so. But in this particular deal, it seems as though all parties should be seeing this as a win-win. And while the financial terms are yet to be found, this is most likely going to be a revenue windfall for Advance Auto Parts, though not necessarily a massive profit-taking venture, as we'll get into. The main part of the story, besides the auto parts, of course, is that Walmart is investing more heavily into their online platform and incorporating well-known brands to take on niche areas of the site. We mentioned this with a lot of brands over the past couple of years, particularly with clothing. They kind of threw up their hands and said, you know what, we're going to just buy these companies outright, these startup companies online that have been really killing it with product selection and design trends and those types of things with apparel. And honestly, this is something that struck us, again, by surprise, because here we're talking about auto parts, more of a plain Jane type of business. But for Advance, this means having a branded storefront on Walmart.com, so something that still elevates their brand, and they bring in their entire product selection, Trent. This is going to be massive for them. This appears to leverage their catalog knowledge, so it makes it easier for those accessing Walmart.com, those customers, to browse and find what they need for a specific project. A spokeswoman for Walmart said that the expertise here will be a focal point. And I think this is important to note because the auto parts industry, there is a lot out there. And to be honest with you, despite what they have done in the past, Walmart.com and Walmart, their standalone business, their brick and mortar business, did not have that many different auto parts. And so if you're going to find an expert in the industry, you're going to have to get with somebody who has been doing this for a long time and already has a lot of their inventory available for sale. Beyond helping with the automotive side of the platform and search functionality, it appears as though Advance's largest role will be in the part of fulfilling orders, this being the revenue driver, of course, for Advance. So all of the orders, this is not just the platform. When you go to Walmart.com and go to their branded site, Advance's branded site, you will be able to buy those products, get those products delivered to your home. They will be Advance Auto Parts' products. So they're going to get that revenue windfall, but with more orders to handle, logically, their inventory levels are going to have to be a little bit more robust, and something that we see consistently in the earnings calls of O'Reilly and AutoZone is trying to keep those inventory levels in check. Sort of going to have to be the opposite model, at least in the short term, as they are going to be more responsible for processing returns, which can be a little more costly, and they'll have less supplier leverage than Walmart, so their costs are going to be up in the short term. If you think about their buying power, they have to prove out that they're going to be able to have that Walmart-esque volume coming in. The partnership is set to begin in early 2019. No specific dates, Trent, were given, but it's going to be in the first half. Everyone was on board with at least saying it's going to be sometime within the first 6 months of calendar year 2019. Despite this news, Advance Auto stock was off 6.5% on Wednesday, but that is not to say their competitors didn't also fall off by the same amount. While the market was pretty much flat on Wednesday, O'Reilly's and AutoZone both fell by around 5 to 7%. So the main concern is exactly what we noted at the beginning of the story with profits, where analysts have noted a significant concern, at least in the short term, for margin compression.
And in the short term, this is more than likely to hurt margins, but this is a long-term game for Advance Auto Parts. And in the long term, as things get ironed out, we personally believe the volume and greater purchasing power should actually help their business fundamentals, as they've been struggling a little bit, not only in terms of sales and the sales metrics and that type of thing, but they've been struggling with growth versus O'Reilly and AutoZone. And as a result, they haven't been able to benefit from economies of scale like those two have. So as we mentioned, even though margins may hurt in the short term, as they scale up long term, we do see some positivity for this deal. But we also have to ask about where else we would have seen Advance Auto Parts growth come from. If you're an analyst, I get the fact that you're worried about margins, but in the auto parts sector right now, in terms of auto parts retail, it's either grow or be left behind. And Advance Auto Parts was very close to being left behind. O'Reilly and AutoZone are continuing to grow at a much faster pace as far as store counts. And honestly, Advance kind of being squeezed out there. AutoZone in particular investing heavily in delivery services. And, the margins would be hurt if Advance put forth as much money into store development or next day delivery as AutoZone or O'Reilly is doing currently. So this is a way for them to forge a partnership that, yes, it may hurt margins in the short term, but long term, it may actually help their brand and help to grow their brand. While Advance has cash to reinvest, they don't have nearly as much as the other two that we mentioned. And so this gives them an in, this deal with Walmart does, with little upfront capital being put forth towards the partnership. Also, customer acquisition costs are pretty much nothing at this point because Walmart's network externality is so extensive. And while Walmart is going to want prices to be low, we don't think they'll be unsustainable going forward necessarily for Advances. The price points of the two retailers aren't that far off to begin with on some of the essential items. Now, at the end of the day, it's about market share. And given that the market for auto parts is largely consolidated, while at the same time is intensely competitive between these three companies, as well as some additional companies that are out there, some smaller companies like Napa, for example, co-ops, any bit of growth and market takeaway can be seen as a net positive overall for Advance. Now, looking at the idea of size and changing gears somewhat, Walmart's size has meant that even the smallest changes in their maintenance costs can create massive savings. This week, the company downgraded guidance as a result of the Flipkart acquisition or part acquisition of Flipkart. However, they did come out with a report of incredible future savings thanks to LED lights and a new floor wax, of all things. So LED lights, something that we've mentioned on the show before, how they've been quick to try new ideas and technology, but sometimes these can be slow to implement simply because of the large scale. We've talked about how LED lights might be able to help cooling costs in the South in particular because they don't create as much heat, but also in terms of the refrigerated goods section, how much money the company is saving on these LED lights, upgrading parking lots to LED lights as well. And Leighton, finally, the company is full steam ahead with pretty much making all major lighting new, energy efficient, LED based.
I sort of feel like Walmart has been taking entirely too long to implement these LED lighting systems. LED lights have come down in cost significantly over the last couple of years, and this is why not only in retailers and other different companies, you see a lot of implementation. They could have just put in new fluorescent bulbs, and they're taking them out now in preference for the LED-based lighting systems. This will actually span all of Walmart's brick-and-mortar concepts, including the sales floor, backroom spaces, and like you said, Trent, parking lots. The savings, once fully implemented over the next couple of years, will come in around $200 million a year, according to their CFO, Brett Biggs. And this, again, raises the main question, why haven't you been doing this in the past? You've seen it in some of their stores, but you have not really seen it in a lot of their parking lots. They've been sort of pick and choose as to what markets are going to implement the LED lighting systems first with, but I think this is something that at least is going to be a positive in our eyes because it is happening. It is going to be with all of their U.S. stores, so I think that's going to be something that investors should be excited about. Anytime you're talking about $200 million per year in savings, it's a substantial amount of money for any retailer. We switch gears and something we never have talked about before in the past, which is floor wax. Floor wax, something that is pretty interesting when you think about how many retailers actually do have to use it. It's an input cost to keep things in operation, things nice and shiny. All retailers pretty much use floor wax except maybe Ollie's Bargain Outlet, for example. But for Walmart, they use a ton of wax. And if you go in during around the midnight hours at any Walmart supercenter, there's usually somebody servicing those floors, making sure they're nice and shiny for next day opening. But they've apparently discovered a new floor wax that is not only cheaper for the volume that they buy, but needs to be applied less often because it's stronger, it's sturdier, it's more rigid than their previous floor wax. And so Biggs, their CFO, logically pointed to the fact that buffing machines will also consume less fuel because they won't need to run as often. So everything that takes this into consideration, the maintenance of their floors, the personnel, the machinery that has to run these buffing systems, honestly, it's going to be a windfall, at least for the short term, for Walmart. Around $20 million in savings just because of floor wax. They anticipate pretty much a win-win in both cases here, as the company will use less energy while saving hundreds of millions of dollars. If you compound that with the LED lighting, the one loser being the old floor wax vendor, Trent. Sure would hate to be the one to lose that Walmart account at that company. I would be very curious to see how much money Walmart was spending on that floor wax in total per year.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Well, we've reached the final segment of the Retail Focus podcast, a segment we call Looking Ahead. I guarantee you in this segment, we probably won't bring up floor wax again. We may never bring it up again on the podcast, but we will bring up a story that we're looking ahead to over the next week, month, or year, and we start with Leighton.
So this was originally going to be in the podcast as a main story. Skechers reported earnings this week on Thursday, and their shares jumped around 7 to 8% in after-hours trading following the release of the company's third quarter. And in that third quarter, you really have to dig through those numbers, Trent, but it was pretty much only positive. It was positive in that they raised guidance for the fourth quarter. They beat earnings expectations. And while they were a little less profitable, they brought in significantly more money than they brought in last year, reporting $1.18 billion in revenue. And overall, that was a slight miss in expectations on the revenue front, but they were, again, stronger on the earnings per share side of things. And they, with that, offered that strong guidance and operational efficiency. They said, looking through the management comments, that they are on track to beat some of their internal guidance for their operations in the fourth quarter. And this is very important because if you think about Skechers, they have a massive international business, but that U.S. business has faced a ton of criticism. Every time we cover one of their earnings calls, Trent, they get criticized heavily from analysts saying, why are U.S. sales only growing 2, 3, 4% versus double-digit gains in their international markets? Well, for these domestic sales, I think a strong Q4 will help push some of that skepticism back if they were to have a strong holiday season. And in fact, one Skechers outlet just opened near where I live, and it is extremely busy. I was kind of taken aback because this was a larger store, but not in one of the best retailing areas yet. It brought a lot of traffic. So I'm curious to see how it performs for the holiday season, but my eyes for the long term are more on Skechers and what they can do in the U.S. market to, again, really taper that criticism that they've gotten. But this is a strong business fundamentally, as their profitability metrics and sales have really gained strength internationally and overall with their business.
Now, what I'm looking ahead to is something that was just actually released this week, but I'm looking ahead to how it could impact the company overall. A couple of years ago, it seemed like every company was putting out press releases about new privately owned brands or new store brands that they were rolling out. These private label brands seemed to be huge in all the talk in 2016 and early 2017. We didn't really see a lot of development on that front over the last year, and certainly not to this point in 2018. But Target, beginning Sunday, October 14th, rolled out a new private label brand to stores, and the private label brand is Smartly. Now, this is marketed a lot like Up and Up, which is another Target store brand there. But here's the deal with Smartly. All of the items, or most of the items at least, are supposedly less than $2, and they're being marketed towards the budget-conscious and, I quote, space-constrained shopper. Now, when I hear space-constrained shopper, I think of a lot of different things. But one of the things I think about is actually one section of shopper that Target has been focusing on a lot over the past couple of years, and that's the college student. When you're constrained in space, if you have roommates, if you live in a dorm, you need products that kind of fit your lifestyle, fit your budget. And in this case, Mark Tritton, the executive vice president and chief merchandising officer at Target, felt like there was white space there for products that came in smaller packages that were marketed more cheaply than other products. And so this is a different take on private label brands, because what we've seen, sizes getting larger and larger. Part of that is due to the merchandising and warehouse clubs that Leighton likes so much, with the Sam's Club and the Costco and the BJ's Wholesale Outlet. We were seeing oftentimes bulk deals there. Target is actually going the other way with this private label brand. So lower quantities, but again, a private label brand that offers items to the budget-conscious shopper. Now, this may not affect them a whole lot for the holidays, but really I'll be looking forward to the first couple of quarters of next year, how it can impact their day-to-day operations, and if it can create more habitual consumers. If they can reach out to those people who are space conscious, let's say, and bring in more of those people on, as they call them, target runs, that will ultimately benefit the company outside of the holiday season and give them a reason for cheer outside of just November and December. Well, that'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent. Once again, a big thanks to AdRoll and AdRoll.com, which helps ambitious brands orchestrate social ads, email, and other marketing channels to drum up more revenue. We'll be back next week with more retail news and information.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.